Okay, with the capital gains tax that has come out, lots of people are wondering about the impact of that, which will be another video, but for this one, lots of people are wondering about, should I sell my property? So this is one of those scenarios that we ran, which assesses, an investor, in this particular case, has owned this property for a long time, bought it at a very low price roughly 10 years ago. It's a single family home. And they have about 60,000 of their capital tied up in this building still. So this is really taking, the side-by-side scenario and saying, should they keep the single-family home? Is that the best thing to do? Or invest in something like a Bill 23 property in a secondary market? And there's a reason why secondary, not primary or tertiary, at least in today's market, which is another video on its own as well. So this model, just to give you a quick reference, is built, I'll give you a quick look at this. So we've got cap rate trends, we've got market value, NOI, suggested DCR and loan amount, and the DCR ratio. Next section is financing. We've got room here for primary, first, second, third mortgages, interest only versus P&I, outstanding balance across all of them. If you had 3 different mortgages, it allows for that, although that's not as common. And then any refis, how much is coming back from those, a rolling P&L that shows us the mortgages, where they stand, the incoming cash flow, and where we stand on a monthly and rolling cash balance standpoint. And then a section here for investors. This might be an individual, which it is in this case, or it could be if you raised capital with partners, you can add in n number of partners and their capital, and that'll track that. Rolling ROI month by month, lender NOI calculations, so we can see at any given time, if we were to refi, what would the LTV be, what would the DCR be, what would the maximum loan amount be, based on the lender and the type of asset. Next, we've got rent roll, where we can track up to 50 units. We can do rent increases, we can do extra gross revenue, we can track utilities, and it tracks the actual NOI month over month as well, and then a bunch of trends. And all of this is captured, you can see, month by month up here. It's all captured across a time frame that is 15 years long. Okay, so once we capture this and enter the data in, then we can start to see very quickly, what does this produce? And that's where these charts come from, right? So what is the trend over the 15-year period? So that's a bit of background on the financial model that builds these charts. So now, what are we doing again to give that top down? We're looking at a single family home, existing investment of 10 years, versus should that capital be redeployed? What would that look like if it were redeployed? This does not take into account tax. That'll be, again, the cap gains tax is a different video on its own. This one is about, what is the asset itself doing outside of the realm of taxes, okay? So capital by year, again, they have roughly 60,000 tied up. In the single family home, they can refi and still stay roughly cash flow positive, reclaim about 20,000 of their original 60,000 in, and then hold on for roughly till year 8, refi, get the rest of their money out, still stay cash flow positive, and that's their capital outlay that they're looking at. What is their original capital doing? When can they get it back? And roughly, excuse me, it's limited by the cash flow, right? So there's lots of equity in this property because they've owned it for a long time, but it's the cash flow that limits it just for now. Okay, so net worth by year. So they're already in a positive net worth standpoint. We see it growing till the next refi, and then it continues to grow. Around the 10-year mark, they're looking at a net worth of around $689,000. Monthly cash flow, we see it getting tight for this first refi, and then building up to around just over $800 a month, and then a refi to reclaim capital, a good chunk of capital, actually not just their original, but a lot more on top of that. And then the cash flow growing back up again as the property continues on. Market value versus mortgage balance by year. We can see we're sitting in a pretty good situation right now, where we've got a 640 value, a mortgage just under 400,000. The 10-year mark in that snapshot is 1.2 million market value, with a mortgage sitting at 631,000. So a good LTV, a good chunk of equity sitting in the property at that point. ROI, they're already sitting strong. They've owned this property for a long time, so that means they have a small amount of capital in it. The ROI grows aggressively up to the roughly around the 8-year mark, where all capital is returned, at which point it stabilizes as infinite ROI. So I mentioned this refi today of around 20,000, another refi at about year 8 of around 340,000, and that's their capital paid back plus about another 317 of profit on top of that, which is good. Now, what if they were to sell that asset and repurpose it? So if they sold it, they're going to reclaim around 230 or 250, 270. They could repurpose that capital into a duplex conversion that was a bigger lot, had the potential for a third unit, either in the main dwelling or as an ADU. They would tie up, so let's just follow the capital by year. They tie up around 275 after the duplexing. This is the hybrid model that I've been talking about for years now, since Bill 23 came out. Well, I shouldn't say years, maybe a year and a half now. So they reclaim, they duplex it, they refi, they get back, roughly 125,000. They leave around 150 tied up until about 3.5 years in, at which point the option would be there to put in another 70, refi, and use the refi capital plus the 70 to put in a third unit. Now we've got a triplex, and we refi and all capital is returned. So let's look at the net worth by year. We see it negative while we're duplexing, which is normal. We see it climbing into the positive, and at which point we triplex it, and now our net worth grows. Same snapshot at 10 year. 10 years, roughly 1.2 million. So 689 versus 1.2. Cash flow at the 10-year mark. So sorry, let me just give you the background on this. We see it start negative again, which is normal for these duplex conversions. It's going to be an empty building for the 6 months that we convert it. And then it sits positive and accrues for the 10-year mark around 3,400 versus 600. So a significant difference in the cash flow. Now let's look at market value by mortgage balance. So we're still sitting on a great LTV, 2 million versus 960. However, if we look side by side, we've got 1.2 versus 2 million. So roughly, call it 750, roughly extra mark in terms of the market value of the asset. And ROI, so we started negative again until we duplex it. Now the projection on ROI is starting to be positive. Around the 3-year mark, it's starting to look like 91%, which is quite strong. And then after that refi, after triplexing it, it's infinite ROI because all capital is returned. Now, when we look at the capital, we've got a $450,000 rough projected return at the 4-year mark versus 357 at around the 8-year mark. So that gives us, the beginnings of a side-by-side assessment to determine, where is the money best spent. Now, like I said, it doesn't take into account tax implications, which would be a conversation with your accountant, and it doesn't take into account, the effort, right? If you hang on to your single-family home, yes, it's capped because it's one rent under one roof, but it's easier. You've already got the property. You don't have to sell and buy again, and you don't have to run these rentals. And so there's an effort and risk tolerance aspect to this that needs to be considered, not just the numbers, right? Obviously, the numbers are a great place to start, and this gives us a view that is much broader than investors typically look at, which is very, very important. When we look at these Bill 23 properties, I've assessed them against a number of different investment opportunities in different markets: Costa Rica, Florida, out west, and east of here. Lots of different markets. And the Bill 23 properties in the GTA, even in the current market conditions, do fare very well. Even when we don't factor in rate drops and pent-up demand and housing crisis and what that might do to house prices. This is more of a standard projection based on 5% appreciation, based on 2% market rent increases, based on 2% cost increases. So there's nothing kind of extraordinary that we're predicting for the future, but rather kind of steady state based on the last, extrapolating from the last 60 years. And the Bill 23 properties, there's pros and cons to every investment. There is no silver bullet and there is no risk-free, and we all know this. But they fare very strong. When you're looking at a net worth of $1.2 million and a cash flow of $3,400 per month, that is a significant. That's a significant outcome for a single investment when run strategically and patiently over the 10-year time frame. All right, so this will be the beginning of a series of videos that I'll create here around, would you rather keep your single family home or do a Bill 23? We'll be comparing a number of different scenarios and showing you the outcome of it, because under the guiding principle that better information equals better decisions. Let's try to get some better information on the table so we can guide our decisions and our direction to get us the outcome that we're after. All right.